Welcome back. It's day 2. I hope you had an enjoyable night yesterday. I hope you did some homework. Some of you emailed, some of you did not. No worries. All right, what we're going to do is we're going to go over the chart from yesterday that I put up, and we're going to look at some of the markups on it. Okay, this was the test chart. A lot of you marked it up really nicely and sent it. Okay. This is just someone that sent in just a minor mock-up. He didn't go too detailed. This is a little more detailed. There's one thing missing on both of these charts. Can anybody see what it is? Or say what it is? Anybody, take a stab at it. Look at this chart closely. It's the name of a trade that's missing. Yep, Greg got it. Safety trade. Yep, you guys got it. Okay, right where he says pins to the mayonnaise, that would be an area where the safety trade would come in. It's a visible stop hunt below the Asian consolidation coming out of level 1. Okay? Absolutely right. A lot of you got it. Good job. Ken, Jeff. Okay, cool. All right. Everyone got this? You want to take a snapshot of this? Go ahead, or actually mark the tape. 6:06. All right. Let's take another test. This one I'm just going to leave up for like a couple of minutes. All right. Label this chart with everything we discussed so far. I'll be quiet for about 2 or 3 minutes. Take a picture of it, and then we'll go over it together. Okay? Starting now. All right. What's in this area right here? You guys answer with me. We'll do it together. All right. Very left corner. Yeah, that's a W. Wow, that's a funky color. I didn't pick that. Hold on. I used that color I used yesterday. All right. Yep. Peak formation low. Right? PFL. I wish I could draw an L like yesterday. Okay. What's in this very corner over here? 3 swipes, or your vector. Yep, vector candles. Past the blueberry, right? Okay, what's this? Level 1 rise. Very good. Okay, what's this? Right, level 1 accumulation. What comes in right here? Okay, what trade is this? Yep, visible stop hunt coming out of level 1. Okay, what do you got here? Okay, L2. One more burst. All right, you guys with me? Trap high, head and shoulders. If you see a head and shoulders present, what level are you in? That's right, level 3. Thanks, Coke. You guys are on top of it. Okay, now, this safety trade also pins to the mayonnaise, right? Pins to the mayo. Pretty cool. All right, did we miss anything? Head and shoulders, aggressive move, dealers trying to trap. Okay, now, I think we covered it pretty good. Yep, 5200 crossover right there. Core to wood, yep. Okay, good stuff. Now, are you surprised? Check this out. You guys see that? It's Australian Weekly. Some of you are not surprised, some of you are surprised. Look, weekly chart. October, March, February, December, September. Yes, Mary, people are stupid on all time frames. This is no different than the 15-minute chart that I've been talking about since you met me, right? Yes, Pradeep. Same stuff over and over again. That's not what he said, but we'll leave it at that. Safety trade. Level 1 rise, an aggressive move out of the area. Okay, remember yesterday I talked about the big picture? Somebody said, Steve, I don't understand while GBP's been correcting or prices dropped on all the majors and came back. Well, here's what's going on. Price has risen for the last few months, since the first part of the year. And then what did they do? They collected enough long contracts. Questions were sent to me this week like, aren't the dealers going to run out of money? How come the market makers can keep dropping price? Or how come they can keep rising price? Aren't they out of cash? What's the deal? Well, here's the deal. People are stupid on every time frames. There's bigger targets and bigger things going on besides the little 15-minute microcosm of the entire picture. Same thing, weekly chart. Okay, what happened? They made the same behaviors that I talk about. They trapped high. And they corrected big against everybody holding longs. And what did they do? If you were in a swing trade long and you had your stop at break even, guess what you got after 3.5, 4 months? You got break even, baby. And if you did that, shame on you. Okay? They faked right past the blueberry. Notice the similarities. Okay? Notice the similarities, how they faked right past the blueberry on this chart. And they faked right past the blueberry on this chart. Isn't that kind of ironic? I think it is. It's the same stuff. Okay? Hopefully you guys see that and understand the bigger picture. All right, let's move on. Anybody want to take a shot of this stuff? Screenshot? It's up there. 3, 2, 1. Bzz. Got it. Okay. Just understand the 15-minute chart, the 1-hour chart, the daily chart, it's all the same stuff. This is all the dealers have. They have these moves. That's all they can do. Okay? All right. We're going to roll into understanding the trading zone. Let's break down the trading zone into some smaller pieces and understand how and what you're looking for. What we want to do is, once you understand the cycle now, we've broken the cycle down. Here's what we've done so far. We've broken the cycle down. We understand the accumulation phase, the timings. We talked about the shadow boxes, the stop hunt zones. How the dealer works the 15-minute chart, but it's part of the bigger scheme of the week, the quarter, the year for that matter. I showed you on the larger time frames a weekly chart where the same behaviors are exhibited on a larger scale, but inside each one of those weekly candles, the dealer set the high of the week, the low of the week, beat the shit out of everybody, dragged them in, took their money. It's the same thing, just a fractional intraday. The intraday is a fractional of the hourly, it's a fractional of the 4-hour and the weekly. So I said this 100 times, the pattern, the pattern, the pattern. And I put that chart up there specifically to make you guys think, oh, typical 15-minute chart. What the hell is he showing me this for, right? It's probably what you said. I just can't hear you tonight, so it didn't hurt my feelings. But when you started marking up that chart, the same exact things, the safety trade. Can you imagine that the dealers issued a safety trade on a weekly chart? Do you realize it took like 6 months for it to develop? How many weeks was that where they rose out of there? Every single day of rise is a week. And then they make the pullbacks and they go into consolidation for 3 or 4 weeks, 5 weeks, 6 weeks. Then they make the pullback, stop hunt. It's the same exact thing. But think about on a larger scale, all this is going on. And in the meantime, you're looking at a 5-minute chart and you're freaking out because of all this behavior, because you're not stepping back and allowing yourself to understand that the 15-minute in the U.S. session when they form the low is forming the low of the week. which in turn might be forming the low of the month or the low of the quarter. So when the dealer traps at these levels and makes these W's, and volatility or risk appetite enters the market, and you go, you know what, man, this is weird because the dealer made a low last week and hit that low again. Well, on a weekly chart, that turns into railroad tracks. If the dealer hits a low a week ago, and he comes right back and hits the same low again and pulls out of there and ends the week up, you've in essence created railroad tracks on the weekly chart. Now that low of the week might come in on Tuesday or Wednesday, which coincides with the normal typical midweek reversal where he forms the yellow W. You understand how you break it down, but understand each little segment. The Asian session, the London session, the US session, each one of those guys works in concert to move the intraday pattern to do the damage to the traders, and it forms out the same exact stuff on the weekly or monthly or dailies. It's the same exact stuff. So try to understand when the dealer makes a low for the week, check to your left. A lot of you are not looking at the larger time frames. You're getting all caught up and jammed up in the 15-minute, and you're just like, you know what? Is this a peak formation low? Am I coming out of level 1? Is there a safety trade available? Yes, Jerry, the patterns are fractal in nature. That's a technical way of saying what I'm trying to say, but you're too smart for me. That's a big word for me. I can't say it. I'm trying to help you understand that when the dealer hits the low and you see the blue tracer and it's the same low from last week or from yesterday, that on the bigger time frame the same things are going on. When you go, Steve, man, he made a low on Monday and hit it again on Friday. On the daily chart, that's going to be a W formation. So understand, man, he trapped on the daily, and now I'm seeing it right here on the 15-minute. That's why eventually, when you start to see these things and notice them, when you walk up to a chart and you go, man, that's the same low from Friday, it's Thursday a week later, he made a W formation on the daily, that's a good trap, this W will pay out. Or I see a safety trade coming off of a multi-hit to the low, or a multi-session W formation. The dealer's trapped on the higher time frames. You won't have to look at anything other than the 15 or the 1 hour or the charts that you prefer. You don't need to go weekly, daily, monthly. When you start to open your mind to the fact that there are bigger things going on, and you start to observe 3 to 5 days of data when you're trading, and maybe just take a glance at the daily or take a glance at where these last trap moves were made by the dealer. You'll understand that, Steve, you're crazy. The price is dropping every day. You said it's a 3 to 5 day cycle. It is. But the dealers have to adhere to the targets that are given to them by the powers that be. I don't know who those powers are. I can guess. But they are given specific targets. And their price has to be at a certain place at a certain time. And that's what they're told. Now, on the way down there, they take everybody's money, they swing it back and forth. Yeah, on the Queen's 60th birthday, perhaps. That's a good one, buddy. They want it. They want the pound strong for her birthday. Who knows the reasons? I mean, there's bigger stuff going on here than you realize. It's not just the market's manipulated. All markets are manipulated. So if all markets are manipulated, then you got to think housing, people's retirement accounts. It's deeper than that. And we could probably spend all night talking about it, but we're not going to learn anything other than that we're screwed and we got to just make the best for ourselves and get on with it. Cycles within larger cycles, yes. Okay, so understanding that should open your mind and open your eyes to the idea that when I'm trading a pattern, just take a glance and see if it's part of a bigger cycle. So what I want you to do is we're going to look at the trading zone. We're going to break it down. And maybe this will help you to realize that the trading zone is not a tiny move that the dealer makes out of Asia. A lot of you want to trade that, and that's okay. A lot of you get jammed up when the dealer widens the swing. This is really not a trade if it's only 5 or 10 pips above the range. The true trades come on the visible stop hunts. The highest probability setups that will allow you to be most profitable. That's what we want to break down. Are other setups profitable? Of course they are. But what you're looking for is, Steve, I have $10,000 in my account. I'm a 1 to 2 lot trader max with a tight stop. I want to find the highest opportunity that I could make 10% of my account in 1 or 2 trades. I want to find the best opportunity that 1 or 2 times during the week the dealer will present to me and allow me to make 10, 20% twice a week. You're looking at 20 to 40% increase on your account, and in 2 to 3 weeks you can double the account. That's the kind of stuff that we're talking about. Not just trading to be trading because, damn it, I'm in my office, I'm here, I want to take something. That's not what this is about. This is about understanding the dealer's behavior, identifying it clean, with no doubt in your mind that this is the move, and then coming heavy, bringing it. And when the dealer does what you expect, you book a profit. And you don't have a lot of drawdown, a lot of aggravation, a lot of stress in your life. You're not exposing yourself to the market. You're not just in a position to be in a position because you're like a junkie, you got to have something going on, you need a fix. It's not what this is about. Control your losses, tight stop losses, above the high, below the low, that comes from getting in properly. When I mean tight stop, we're going to talk about where the stops are placed, but a tight stop is also a mental stop. And I don't mean you don't put any stop on there. There's 2 types of stops that we're going to talk about this time, and what they are is this. Your hard stop loss, which is outside of the reach of the dealer, which is that if anything goes wrong, there's a spike, anything happens, you get taken out and you preserve your equity. But the mental stop, what is a mental stop, Steve? Are you mental? No, this is what a mental stop is. You're watching this pair and it forms a perfect M or W formation and you take it. And within 30 to 45 minutes, the dealer comes back and extends the high or extends the low. Okay, well, if he doesn't come right back below that high or above that low, the next move is that the dealer will probably extend to the next level strike zone, which is 25 to 50 pips higher. If the dealer extends the high, in this example, comes back and extends the high, this is a mental stop area. Why would you let him take 23 pips or 25 pips from you when you know the dealer has extended the high and has not come back below that high? The next move is an extension to the next level. If you know this, why not close the trade and save yourself a few pips? It's not just about how much you book, it's about how much you keep. And this discussion reminds me of a post from a dear friend of mine, Dick Schmidt. I don't know if he's in here or not. He's way past needing to retake my class, so if he's not, I'm not offended. But he posted in the forum about controlling your losses and wins. He had a night where he lost 3 out of 4 trades in pound CHF. But because he has enough sense to control his losses, he ended up with plus 43 for the day. How did that happen? How could you lose 3 trades, Steve, win 1, and come out plus 43 for the day? I'm going to tell you how. Because when the dealer extended his high or his low, he cut it with -3, -7. He had enough sense to realize, I made a mistake on my prediction or on my entry, and I'm not so pig-headed that I can't just cut it and look for a new entry. If you get stopped out, who says you can't go back? That's retail garbage. Oh, if your stops get hit, stand aside. That's retail trader jargon. That's for jerks. If your stops get hit, you reevaluate the market and try to figure out what the dealer's next move is. What can the dealer do? Hit the stops high, hit the stops low, straight rise, straight drop. Okay? 3 levels of rise. If you're in this situation and the dealer extends the high and you take a -7, what is he going to do? He might make an extension to the next level, 25 to 50 pips above the previous high, and then what's he going to do? He might make an outside structure incorrect. Okay? So if you got jammed up in here and you came out -7, are you going to stand aside and cry that the dealer got you for 7? Or are you going to wait for the outside structure to present itself and capitalize on this new opportunity and get back your 7 and then some? So if you book 50 on that, you're plus 43 for the day. I got a couple nice letters. There's a gentleman out in Australia. I don't know if he's here, mate. But he had 20 wins in a row. His account was increased by 63%. And he had one loss / scratch that was +3. He didn't count that in his winning. He called that a loss. +3 is a loss. These are the kind of numbers that the students are capable of posting and that I want for everyone. But it's mitigating your loss and understanding that if the trade doesn't go within a few hours, you got to cut it. You got to have an open mind, trade both ways. When the dealer extends a high or extends a low, realize that, man, I've made a bad entry. Let me squash it and move on. You got to figure out a way to check your ego and set it aside and allow yourself the vision to see both ways on the chart. And when you can do that, it will increase your success tenfold. How do you get there? Everyone's different. I don't know. It took me a while too. It's some kind of always having to be right. And I found that people that, and I don't mean any offense to anybody, but the know-it-all types, however those are, ask your wife if you're that kind of guy, I don't know, or that kind of girl. If you're that kind of person, it's harder for you. So, understand you have to analyze your own personality and see what kind of person you are. If that's the kind of person you are, it's going to be a difficult road. Maybe you need to go to the self-help section in Barnes & Noble. Because you got to figure out, you got to view the market objectively and understand what these guys are doing. And you got to look beyond your own flaws and see it for what it is. And I don't know how to help you with that. I can show you this stuff till I'm blue in the face, but you got to get beyond the flaws. All right. We talked about the cycle last night. The ideal Asian range is 50 pips or less. Right? We talked about the Asian range, how it lays out. An ideal Asian range, 50 pips or less. Steve, I saw a range that was 52. Can I still trade it? Yes. If the range gets blown out around 75 pips, it's harder to see the stop hunt. Is it still doable? Yes. Particularly if you reevaluate the last 1/3 data. All right? So if you look at the last quarter to 1/3 of the box and you reevaluate the consolidation, so here's what happens. You have an overblown box of 72 pips. Okay? The dealer has done this. Okay, now, in the last part of the cycle, this might be visible. So what you need to do is reevaluate this data. And if the dealer makes a stop hunt high, you understand you measure the distance from here to here, and it needs to be 25 to 50 pips. All right? That's what we do if the Asian range is blown out. It is, in fact, tradable, but I like to see, ideally, tight Asian range. It means the dealer did a good job of accumulating contracts, and if he holds the Asian range tight, we expect a clean, aggressive move out of that area. Okay? The trading zone is always set 25 to 50 pips higher than the Asian high or the Asian low. So what we're talking about here is we measure the distance from the top here, the initial high, the IHOD, I'm just going to write IH, and the IL, the initial low of the day. We're talking about a distance from here, 25 to 50 pips. Same thing here, 25 to 50 pips. The reason for that is that where does everybody put their stops? 25, 30, 35, 40, couple smart Alex, 45, 50. The dealer triggers those stops as part of the cycle. So what happens is, if you put your stops, if you took a trade in the Asian box and you put your stops where everybody else puts them, the dealer makes light work of collecting those stop losses because Listen, it's like a joke to them. They know where they're at. They see them. And people put them in the same spots because that's what the technical books teach. So there's hundreds of millions of dollars of stop losses laying out there. They just simply have to move the market as part of the progression and take it. Okay? Understanding, adjusting the trading zone in the last part of the box will give you some more insight to which way they're going to go. A lot of you were using the box and saying it's blown out and you're just passing on the pair. You can and are still able to trade if you reevaluate the last 1/3, the last quarter of the box to see where they're at. So, an example, one of my slides, in fact. There might be a news release, let's say Euro-odd early, and it spikes like this, and then it goes into consolidation. Maybe there's a low here, and then what happened? You analyze the last consolidation zone, and I'll find that slide for you guys. And the dealer makes a spike to the low and then rises. So if there's a news, obviously this box was like 107. Sorry about my zero. Okay? So if they move early within the box or the box is blown out, these things are tradable. And my adage for that, and I say it all the time, and I would be remiss if I didn't say it, you are smarter than a blue box. The blue box is stupid. It starts painting at 5 and ends painting at 1. That's it. That's its job. And it calculates the high to the low and plasters it on the lower left-hand corner of how many pips it's moved. It doesn't know, oh, there's news today. Let me take that in consideration. It doesn't know, oh, man, box is blown out today. It doesn't know anything. It's just a box. You have to be smarter than this box and understand where to take the entries. All right, trading zone. 5 p.m. blue tracer, some of you 6, some of you 4, depending on where you're dealing at and what part of the world, okay? Now, here's what we got. The accumulation area. We're looking for a move to come. When is the false moves? End of the session, beginning of the session. We're looking for the dealer to create the vector in the last part of the Asian session, going into the opening of London through the gap time, perhaps set up a Brinks, give us the second leg repeat in the first part of the London session. Why? False move, session ending, false move, session beginning. So what would you have? Think for a minute now. Okay? End of the session, false move up. The dealer pulls back. In this time, the session or operator has changed over. There is now a new guy on the desk. False move, session beginning. Bam. He comes right back and gives you the false move, which in turn paints the M or the W. That's where the M comes from, because the dealer is faking in line with the Asian market maker, Asian operator. What happened is the Asian guy ended the session in a vector breakout momentum mode, which retail traders call and see. He then makes the pullback to trigger the stops and induce some shorts. He switches over during gap time to the new operator. The operator comes on his desk. He says, what do you got? I just vectored to the high. I extended the initial high. I got about 500 million built up. I need you to trigger the stops. Pick up those pendings above the 50 pip area. And let's correct out for the session. Got it, dude. Have a great day. So, session beginning, the false move comes in. He makes the second pass towards the number, which validates all those patterns that everybody talks about in the books. And then he starts the trend where he will shift the zone away from higher level longs, make his run for the day, and end the day back in consolidation. Take a picture of the slide. It's pretty good. It's a good slide to have. Now, obviously the ADRs have been a little lower. The dealers have not been hitting the shadow boxes, or the stop hunt boxes like we like to see. But they still hit them. They're still there. They still find their way into them. And when they do, and the pattern presents itself in this grayed out area on your chart, these trades are very, very reliable and probable. Okay? So, ideally, what's happening is, because the dealers haven't been presenting to you what you want to see, you've been taking trades that are maybe not as pretty, or maybe one pin to the top side, 5 pips above the box. And I understand you want to trade. But the goal is to trade less frequently, more accurately, if that makes any sense. Okay, a couple guys turned the corner, 5 for 5, I told you yesterday. Some of you are trading 15, 20, 30 times a week, and I think my friend Dave McCoy, if he doesn't mind me throwing him out there, throwing him under the bus, he's a great guy, I love him. And I think the world of him. He turned the corner, and you know what happened? When he first came to me, he was trading 20 to 30 times a week. What was his equity curve? Slightly up, sideways, slightly down, back to the middle, slightly up, slightly down. It's not about activity. It's about quality over quantity. Guess who he was paying 30 trades, clearing the spread 30 times? Think about that. He's paying the dealer. His equity wasn't going up. He wasn't gaining control of his life and his financial future. He was paying the hell out of the dealer. And now, anywhere from 2 to 5, 6 trades a week, quality. He has weeks where he's 4 out of 5, 5 out of 5, 6 out of 6. I don't know how to teach you guys that or how to say it any different other than it's about quality and not quantity. And that what you need to do is wait for the trades that strike in the zone and that fall in the shadow box and set up as a Brinks. Okay? I mentioned to you another gentleman from Australia, 20 winning trades in a row for the month. Well, there's 4 trading weeks in a month. What does that average? About 5 trades a week. Okay? 20 trades for the month is about 1 trade a day. So what is he doing? How could he be so accurate? He's waiting for the set. Remember I talked to you about Point Break, the movie? The surfer standing there, Patrick Swayze, staring at the water. Keanu Reeves walked up to him and he goes, "Bodie, what are you doing, man?" And he's like, "I'm waiting for my set." He's waiting for the dealer or the waves or the ocean to give him a perfect set of waves. What I'm asking you to do is wait for your set. Whatever that set is. A lot of you haven't established that yet, but you need to pick a signature. If it's going to be a safety trade, pins to the mayonnaise, whatever your signature trade's going to be. Now, I'm not big on the discipline, blogging, and all the garbage. But what I am big on is that you need to pick a set of circumstances or a scenario on the chart that works for you. And when that scenario presents itself, you need to pounce on it. And, Joe just now brought up a good point. He said, better to limit how many pairs to follow. No, here's the answer. It's not the pairs, my friends. It's the pattern. Okay, let me say that one more time because I should have a slide for that. Maybe I'll make a t-shirt. It's not the pair. It's the pattern. You're not trading a pair. Do you care if New Zealand goes up or down or yen? You're not loyal to a pair. You're loyal to a pattern. And if you become loyal to the pattern, you will get paid. It's not about, the euro. It's about, did the euro make the market maker pattern that Steve taught me? That's the answer. So if you monitor 4, 5, 6, 7 patterns, then what you need to do is you need to say, okay, I'm going to trade a safety trade coming out of level 1 on any pair that it shows itself to me in. Okay. Well, guess what? I told you that the peak formation has to be locked in place. You know that a day or 2 beforehand. So that means when you're doing your homework, if you're a safety trade, signature only, if that's your trade, you got 12, 15, 18 hours to figure those out. You can see those coming from a mile away because what has had to happen? The low or high of the week has had to be set. The dealer has to anchor. And he has to be in consolidation. Now, everyone can see that on a chart in any pair. You realize that it's presented in EuroCAD and it's showing up in Australian USD. Okay, Those are my two pairs that I'm going to watch tomorrow. Now, the dealer breaks low, makes a V bottom, or the dealer breaks low, makes a W as a safety trade. That's a trade. Okay. Something very important just came up. And Helen wrote, the spread on that pair is too high. It's too expensive for someone not successful. Well, guess what? It's bullshit, Helen. No offense. I love you. The spread is insignificant if you catch the pattern properly. Why? Because the pattern is more important than the pair. If the dealer exhibits the behavior in that pair, that pattern will pay out irregardless of the spread. The dealer doesn't go, oh man, I'm going to make the pattern in EuroCAD, but it's got a 9 pip spread. Maybe I'll just make half a pattern. It's not what he says. He traps people in the same places on EuroCAD, EuroOdd, EuroGBP, that he traps them on Euro, Yen, Pound Dollar. He traps them in the same places. He traps them with the same patterns and the same stuff. So he doesn't care that it's 9 pips or 2 pips or whatever your dealer's offering you. He cares about his trap move. In this example, coming out of level 1, he's going to make the same behavior. He's going to show down and rise. Your loyalty needs to be to the pattern, not to the pair. Okay? So, with that in mind, if you're struggling and you're looking at a minimum of 1 or 2 pairs or 3 pairs, that's fine. I want you to continue to do that until you start to see things. But as you become more successful, your loyalty is to the pattern and not the pair. Keep that in mind when you're trading. It's important. All right? Blown out box. Look at the action right here. Dealer extends the low one more time. Trading in the middle of the chart is not for the light at heart. You're looking for specific behaviors on the fringes. You're looking for a long near the low, a short near the high. That's it. That's the business. Okay? There are some advanced students that are taking the safety trade intraday, and that is acceptable. But here's the deal. You're new. Some of you are still struggling. If you have not turned the corner yet, the no trade zone was designed for you. I don't want you taking garbage in the middle. I want you to trade the fringes, the outer edges of the range. That is where the most success will come to you. The easiest chance of success comes in the outer fringes. This is no trading in the middle. You're looking to deal near the high on one of these 2 hammers and near the low on the other hammer. Isn't that funny how we talk about the dealer does the same thing over and over again? Isn't that ironic that the dealer issued hammers at the high and the low? I love this chart. He issued 2 hammers back to back right there. Okay, look, he issued a hammer there as an outside structure. Dealer pins to the mayonnaise, railroad tracks to the high. Okay, look. Okay? The dealer issued the trap candle, what I'm going to talk about, on both ranges of the spectrum. It's easier to see. Is this pullback in here tradable? Yes. But I want my friends that are still learning and that are new to the family to trade the outer edges. Okay? Target, watermark, and out. Okay? No trading zone. The center, the dealer. What has the dealer done in this example? He vectored to the high, and this is Australian USD. You will notice this behavior in Australian, Canadian. The reason why is that in this example, the dealer has worked the high to mid-session, or got to the high mid-session and held it going into the U.S. session. if you see the dealer set the high for the day and hang around for a while and not break it and work it, the pair will correct. Remember when I talked about there's something bigger going on? Here's what's going on here. He is accumulating long holding contracts by holding Australian USD, which AUD is the base, by the high. He's creating a disparity in the cross fractions. Might be Euro AUD, might be AJ, Australian JPY. He's creating a disparity by holding Australian USD near the high, and conversely, if he does it near the low, it's the same behavior. Okay? So now, if the dealer goes up to the high and he starts chopping around, a better setup is when he outside structures high and stays there. And I'll show that picture soon. If the dealer holds the high and he holds it from mid-session into the U.S. session, the pair will correct. You can take a position. Wait for him to get into the U.S. session. Wait. Why? Because he's liable to hit the stops one more time. Remember? Don't trade until we hit the stops. Woo! All right. No singing for Steve. That's it. It's my concert for the week. All right. And what does he do? He railroad tracks one more time high just inside the red box, and he gives you, and he comes back one more pass. He gives you a mild M formation and confirms that trade by closing below mustard and ketchup. Okay? So if you see this pattern presenting, the trade is taken into the U.S. session. Okay? 2-hour time stop doesn't apply because you're not in. You're not in. You're not in. The 2-hour time stop applies after the consolidation. The dealer hits the stops 9:30, 9:45, and he corrects. You look for the trade. And yes, absolutely, if there's a peak formation low right here, you're not going to trade back towards this, of course. But look at the separation. You know we're not in level 1. Okay? All right. Some rules for you to profit by. Very important. Okay, write these down. Mark the tape. 6:53 New York time. You got to stop trading every day. You need to show up every day. I need you in your office every day. Sunday to Thursday, or depending on what part of the world you live in, Monday to Friday. You got to show up every day. But if there's no setup, there's no trade. You need to learn how to become highly selective, whatever that means to you. You new guys, by the end of the class, I need you to start to consider a selection of what I call a signature trade. When I go over all the trades, you're going to have to pick one that you see clearly, that's easy for you to recognize on the chart, and that will become your signature. That is your primary trade. That you look for that trade every day. You scan the market for that trade. You're going to have a secondary backup trade, and you're going to have a third trade or tertiary. It's a tough word for me. Now, I want you to scan and become disciplined with your signature trade. Let's say it's going to be a peak formation high, level 1 consolidation. I'm going to take the safety trade, stop hunt. Okay, then you scan the market for that trade. And when you are certain there is no safety trade setting up, then you fall back on your secondary trade. You understand? The secondary trade is not your, I don't see shit, I'm going with that. I don't know. I looked at Euro, and Euro's not doing it. That looks pretty good, I'll take it. That's not what I'm talking about. I'm talking about since the safety trade takes a day to set up, you need to make sure, go through all the charts and go, okay, where's the high and low of the week? Let me look at the 4-hour. Has the dealer violated the psychological support and resistance zones? Has he made the high of the week? Has he made the low of the week? Okay, he's already corrected off that high. He's in consolidation. Bam, Euro looks right for the taking. Bam, Australian looks pretty good. Those are my 2 pairs I'm going to monitor. If he's straightaways, I'm going to pass because I don't understand those straightaways yet. But if he gives me that visible stop hunt as a safety, I own that bastard. That's the mentality I want you to have. Here's your trading hours. No more 15, 20-hour marathons in front of the screen. If you're doing that, shame on you. It stops right now. Set your hours as follows. This is it. Write it down. Trade the end of the Asian and London Open for about 4 hours. That's it. Coming in around the end of the blue box, 1 o'clock New York, 12:31. I come in around midnight, look at my emails. Takes me all night to answer them. And I'm looking for something by mid-session that looks enticing to me. Enticing to me means the dealer has vectored out of the box, hit the high or hit the low, extended that area, hit the shadows, maybe threw a hammer in the Brinks in the second leg of the W, in the Brinks shadow. Or maybe he formed the high of the day with railroad tracks in the Brinks shadow. That's what I'm looking for. That gets me jacked up. That gets me excited. If I don't see nothing by mid-London, I get up. I might run around the house. I might go outside, get some fresh air. I might jump in the pool. Something to get my blood flowing and get me feeling good. Because when you sit at the desk and you stare at the screen, it's a tough job. And what happens is you let your imagination run away. And you're like, you know what? I want something today. I need a trade. I'm going to go ahead and just take this quasi-WE looking thing because Steve said W's work. That's what happens. And then people go, Steve, I'm having a tough time with these patterns. And the first word out of my mouth is, send me your trades. And when they send me their trades, it's some bullshit M formation taken at 6 o'clock in the evening because they just got home from work in the Asian box. The whole range is 12 pips and they found a W or an M in there. How the hell do they find that? I don't even know. And I apologize if the person that sent me that email is in here. Love you guys. But understand, I set the trading zone for you. I'm showing you how it is. I'm telling you mid-range and Asia is not the trading zone. The blue box is not the trading zone. Are you going to miss some trades in the blue box? Hell yeah, you're going to miss some trades in the blue box. Do I care? No. Why? Every day the deal will make a new high and a new low. It's up to me to control my emotions and identify those areas and trade them. I think someone quoted me on that somewhere. I don't know. Okay, so you take your break. You come back at the end of the London session and you trade in the U.S. session for about 4 hours. Now, Steve, I only want to trade one session. No worries, man. You come in the 4 hours for London, and maybe since you're only going to trade one cycle, you stay another hour, 5 hours or so. Or you come in around 8:30 for the U.S. session, and you wait for the dealer to hit the stops at 9:30, 9:45, and you look for your trades. If the dealer's made the W around 8:30, that's still viable. So then you would take from 8 to noon, or you would trade from 1 to 4 or 5, depending on what session you want to trade. So if it's one session you're going to trade, then you extend the hours a little bit for yourself and stay for London, or you extend your hours a little bit and stay for U.S. But don't extend your hours and stay London through U.S. That's not what I'm advocating. The idea here is time, leverage, and freedom. Standing in front of the computer for 15 hours will not produce results, and the market makers will not make a trade because Randy Catholic sat in front of the computer for 13 hours. Doesn't work like that. Sorry, Randy. Just happened to see your name real quick. Okay? Understand? Now, the next important part is to learn to capture 50 pips, not 1 pip more. Greed kills more good traders than anybody I ever met. Okay? You have 35, you don't want to take it. The pattern's right in your face that they're going to reverse because it was up 50, now it's at 35 in consolidation, about to make the reversal, and you just got to have your 50 back. Why 50 pips? Well, 50 pips is the average size of a stop hunt, or on a tight ADR day where the pairs are not moving much, it's a reasonable amount to carve out. Okay, that's a good one, Joe. I'll share it in a minute. What you're going to learn to take is only crystal clear setups, whatever that means to you. If you see pins to the mayonnaise, If you see W formations clearly, if you see safeties, that's what it is, whatever that is for you. Now I had to grab a sip there real quick. All right, so why 50 pips? Here's the reason why I'm telling you 50 pips. Let me grab a pen. Okay, it's because you're not going to deal from the absolute bottom or top. That's where I get in. All right, I'm kidding. Realistically, you're going to deal 10 to 15, 20 pips off of the formation. You're going to learn to deal in here. Right? You got to include the spread, and as your contracts increase, you got to account for slippage and bullshit that the dealer's going to pull on you. You got to account for that. So let's add 5 on average. Okay? So we're at 15 and 5 is 20 pips, right? We already know that all 3 levels do not present every single day. You might get 2 levels, you might get 1 straight drop into consolidation. The news screws up the levels. Non-farm is a level killer. So if you have level 1 and 2 or a decent ADR move from the intraday peak formation high or low to the day end consolidation, if the average small ranging pair is about 100 pips, there's enough for you to carve out your 50. Okay? Here's what I mean. Let's say this is a 100 pip range for the day. Okay? You want to deal off of the high or low as close as you can. The dealer slips you, your true entry is here. With all things being equal, you're looking to get out somewhere in here. Now, it doesn't mean you can't come back in here and get out in the consolidation and pick up another 30 to 50. I mentioned to you before that there was like a 110 pip range, and I got a chart from a guy that carved 100 pips by grabbing 50 off the high and 50 off the low back into consolidation on a day where price opened high, extended the low, came back near the high. He traded short off the high, long off the low, and the ADR for the day was 110 pips, and he grabbed 50 of those. Pretty amazing stuff. Okay? So what I'm telling you is intraday you usually get about 2 pushes. You get the stop hunt high or low, the dealer pulls away from that, shifts the zone, he'll hit the stops, and drop again, and maybe go back into consolidation. About 2 levels will present on a regular basis. So from peak formation high to day end consolidation is about 75 pips or so, right? Available to you in this move. Might be 100, 110, but dealing off of here and getting out, there's 50 pips available to you to take relatively easy. Okay? It's just understanding the peaks where they come in, how to master those. Okay, so understanding that, stop being greedy, start aiming for 50 pips. You're going to hit your limit every time you trade. You're going to have an opportunity to book profit from both ends of the range in multiple pairs. When you become proficient, you're going to get a setup in euro, a setup in franc, a setup in pound, and you're going to take those trades off of the peak formations, and you're going to tag 50 on 2 or 3 pairs in a day. You're going to book yourself 100, 150, 250 pips on a combination of pairs. Okay, what I'm talking about, a minimum of 100 pips per day across the spectrum of pairs without overtrading, without driving yourself crazy. That should be enough for you to live on. If you can, I can't help you guys. Because the goal here, like cutting the hours back that you spend in front of the screen, is to also use the leverage available to you to increase your contract or to ramp up the size of your position, which has been the dream of most of you, but you knew your system would let you down, so you couldn't do it. So now, if you've been a 1-lot trader, but you have enough equity to trade 2, 3, or 4 lots, when you see a perfect M formation with all the other variables that we've talked about, you can go ahead and take a 2-lot trade. And instead of making 25 pips with one lot like you used to do. You can now book 50 pips on 2 lots, which is like 100 pips. You can bag $1,000. It's what you want out of the business. Don't trade to be trading. Trade to make money. And every other time, preserve your equity. If you owned a vegetable store, you wouldn't just buy a bunch of vegetables and stick them in the back and hope you sell them before they rot, would you? Then what's the difference? Your equity in this business, your money in your account, is equivalent to your produce, your inventory, your stock in a regular business. Would you just open up the front door of a shoe store and start throwing pairs of shoes out on the street? No, of course you wouldn't. So why would you take your money in the Forex market and ball it up and throw it at the dealers? Your equity in this business is your inventory, your working capital. It's no different than any other business. And if you treat it like that and understand that, man, that's my equity, that's my inventory, I need to put my inventory to work and rotate it through the market and pull a profit on my inventory. That's how a business is run. Isn't that like Business 101? Buy something, mark it up, and sell it. Well, guess what? You take your equity, your inventory, you throw it out into the market in a calculated risk, and you pull it back in plus a profit of 10, 20, 30%. That's how you work the Forex business. Not, I'll just wing it, see what happens. If I get stopped out, I get stopped out. Stop losses are an inevitable part of the business by controlling your risk. But you also have to understand that your working capital is the inventory of the Forex business. You don't have an inventory per se. The inventory is your capital. So in order to preserve capital, you use tight stops and you become very selective in your choice of trades. That, my friends, is how you turn the corner, start to make money rather than just trading. Okay?